right. Before we dive in, just a little bit about me. So I graduated Northeastern Law School in 2010, which is crazy. I can't believe it's been over 10 years at this point. I founded a solo practice shortly after I graduated, focused entirely on helping student loan borrowers and their families. I'm based here in Boston, and I've been doing it ever since. So I help folks navigate student loan repayment and forgiveness programs, help folks deal with disputes with their servicers and other entities, and I also help folks who are in trouble, they've fallen behind, or are dealing with issues like default and collections or negative credit reporting, things like that. So what we're going to do here, student loans can be really tricky to navigate and really stressful for a lot of people. If that wasn't the case, I wouldn't have a job. So I'm very familiar with how awful student loan debt can be. My goal here is to sort of give folks an overview of the system, to touch on some of the key programs that might be relevant to you as you're dealing with loan repayment and loan management and how best to handle these loans. We'll also talk a bit about some of the latest developments in student loans, including the current payment suspension, questions about whether there'll be student loan forgiveness at some point. And then, of course, we'll save plenty of time for some Q&A before the end of the hour. So with that, let's dive right in here. So some background. I mean, the numbers here are just astounding. Currently, the total outstanding amount of student debt is about $1.7 trillion. Just to put this in perspective, when I first started doing this work back in early 2011, I believe there was about 800 billion in total outstanding student debt. So basically in the 10 years that I've been doing this work, we have more than doubled the volume of outstanding student debt in this country. It is the second largest type of consumer debt in America, second only to mortgages. That means there's more student loan debt than there are car loans, credit card debt, medical debt. Over 40 million Americans have student loans. That's about 1 in 9. And 70% of college students are graduating with some amount of student loan debt. And almost a quarter of those folks who have student loans are in some sort of problematic status. They're either behind on payments, they're in default, or they're in some sort of hardship non-payment status. So the numbers really tell a story. When folks refer to this as a student loan crisis, I don't think that is an exaggeration. So when it comes to managing your own student loans, there's really 4 pieces of information that you need to make a really informed decision about how to handle and how to manage your debt. You got to know what type of student loans you've got. You have to know who is handling the loan. What is the entity? What is their role? Because that's going to play a major factor. What is your status? Are you in repayment? Are you behind? Are you in some sort of suspended status? And finally, what are your options for repayment? And of course, are there any loan forgiveness programs tied to those options as well? Those are the 4 pieces of information that I think anyone needs to make informed choices about how to deal with their student debt. So when I say that student loans are complicated, if you don't have student loans, you just don't know what I'm talking about. But this graphic, I think, really illustrates how complex the system is. When we talk about student loans, really, student loan debt is this sort of big, broad umbrella term. And then underneath the student loan umbrella, you get the different types and categories of student debt. Student loans are going to fall into 2 very broad categories. There's federal student loans, and then there's everything else, which we call private student loans. Under that federal student loan heading, you have 3 main student loan programs that you're going to encounter. There's the direct loan program, which are loans issued by the government, by the Department of Education. There's the FFEL program, or FEL, which stands for Family Federal Education Loan Program. Very brief history, up until 2010, there were these 2 parallel loan programs, direct and FEL, through which you could get Stafford loans and PLUS loans that were issued to graduate students or to parents for the benefit of their children. The FEL program was discontinued in 2010, and since then it's been mostly direct loans, but there's still a lot of FEL loans out there for folks who graduated or completed their degree program in 2010 or before that. And the reason why this is important is because some of the newer programs and the more popular programs that borrowers want to take advantage of are limited to direct loans only. As we'll talk about, there are ways of addressing that for FFEL loans who might be locked out of some of these programs, but understanding whether your loans are direct or FFEL program is an important first step to understanding your options. There's also Perkins loans, which are neither direct nor FFEL. These are federal loans that are issued by the school. And Perkins loans have their own unique quirks and possible benefits. Generally speaking, if it's not one of these types of loans, it's almost always going to be a private loan. Private loans can be issued by a traditional commercial lender like a bank or a student loan lending entity like Sallie Mae, Navient. It can also be issued by the school. Some schools will issue in what we call institutional student loans, where you owe the school directly. How do you figure this out? Well, if there's one thing that you jot down, I think one of the most important takeaways is this website, studentaid.gov. This is the federal U.S. Department of Education portal for all things federal student loans. If your loan is federal, it's almost certainly going to appear on this website. It requires an FSA ID, which replaced the older federal PIN system. It's a unique username and password. Never share your FSA ID with anyone. I never ask anyone to provide that to me. So you should never, if anyone asks you for it, they don't need it. It can be used to sign for loans and to enter into programs. So you don't want to give that information away. But that portal can give you really important information on your federal student loans, including the type of loan that you've got. Is it direct? Is it FFEL? Is it Perkins? Who is handling it? What's the status? What's the history? What's the interest rate? Whole bunch of really useful information in there. You can also look at your applications. If you got it, your bills, if it says Stafford or Plus, that almost certainly is going to be a federal loan. If it's not in the federal database, in most cases, it's going to be a private loan. And there is no one-stop shop like the FSA database where you can get private loan information. Your only real option is to pull your credit report, which you can certainly do. I encourage folks to pull their credit reports about once a year. You're permitted to do that for free under the Fair Credit Reporting Act, and that should have all outstanding debts on there. You can also look for other clues. Typically, there's a cosigner on a student loan. That's an indication that it's a private loan. Most federal loans do not have a cosigner, but a lot of private loans do, and a cosigner is equally responsible for the loan just as the borrower is on a private loan. The reason why this initial distinction is important is because federal student loans have a lot of options for repayment. Private student loans have relatively few options for repayment. You're stuck with whatever the terms are under the contract that you signed, whereas federal programs through statute can provide borrowers with a lot more options. So next, you got to figure out who's involved with your loan and what's the role that they're playing, because that will tell you who you need to contact. The lender is the entity that originates the loan. So for direct loans, which come from the government, the lender is always going to be the U.S. Department of Education. The Department of Ed functions almost like a bank for all intents and purposes when it comes to the direct loan program. For FFEL loans or FFEL loans, that usually is going to be a commercial or private lender that issues that loan, and then it's backed or guaranteed by another entity and ultimately by the government. So that's the main distinction between the direct and the FFEL loan programs. If you default on a FFEL loan, a guarantor or guarantee agency takes over the FFEL loan from the lender, and then you owe the guarantor instead of owing the original lender. Some private loans have a guarantor as well in some cases. They all sort of insure the loan or insure the lender, really. Importantly, a loan servicer is the entity that deals with the day-to-day operations of a student loan. In many cases, the student loan servicer is not the owner of your loan. They do not have any ownership over the debt. They are simply a contractor acting on behalf of the lender. For instance, the Department of Education, for their direct loan program, they don't service their own loans internally. You will almost never actually speak with a Department of Education employee. You're going to be dealing with one of their contracted servicers like Navient, Great Lakes Higher Education, Nelnet, Fed Loan Servicing, Ed Financial. These are all contractors who act on behalf of the Department of Ed to handle the operations of the loan. And the servicer is the entity that you're most likely going to be dealing with on a day-to-day basis. A collections agency is sort of like a servicer, but in the context of default, they will take over the loan in the event that you default on it. It's important to understand what roles these companies are playing, because some of these companies play multiple roles here. Someone comes to me and says they have a Navient loan. That doesn't really tell me anything. Navient is a lender for private loans. They're a servicer for the direct loan program. They are also a servicer for the FFEL loan program. They, in the past, have fully owned and operated some guarantee agencies, and they also are affiliated with some collection agencies as well. So it's not enough to know who the company is. You have to know what role they're playing with regard to your loan. So we did loan type, we did loan players or loan entities. Next thing you got to figure out is what is your loan status, because this also is going to determine some of your options here. So a grace period is a one-time use period, usually about 6 months for most loans, 9 months for some loans like Perkins loans, immediately after graduation, during which no payments are required. The idea here is that, once you graduate, you need some time to get a job, get your housing situation figured out, and you shouldn't have to make payments during that transition period. Key thing about a grace period is that it's one-time use, which means that if you graduate college, you use your grace period up for your undergrad loans, and then you subsequently go back to school for a graduate degree, and you take out new loans for your graduate degree. When you graduate from that master's or JD program, you might owe your undergrad loans right away because you've already used up that grace period. You don't get a new grace period every time you go back to school. So that's something that some people trip up on. So just be aware of that. Ideally, folks will be repayment or current on their loans. You're getting billed, you're making your payments on time, everything is in good standing. A couple ways of postponing your payments: deferments and forbearances. We'll talk about that in a second. If you're behind on your payments, we call that being delinquent or being in delinquency. And then if you're so behind that the contract that you signed is considered to be breached, that is what we call default. And that can have very serious consequences like credit damage, collections efforts, fees and penalties, wage garnishments. So it's not a good place to be. So deferments are a mechanism to postpone your payments during a time of hardship or other qualifying periods. Common type of deferment is when you're in school at least half time. That's why when you're enrolled in school, you don't have to make payments, because you have an in-school deferment. Certain types of graduate fellowships can also allow for a deferment. And then there's hardship and unemployment deferments as well. Federal student loans have pretty generous deferment options, up to 36 months in some cases for hardship and unemployment. And interest is not accruing on subsidized federal loans during a deferment period. That's what the subsidized means. It means that while you're in school and in other qualifying deferment periods, even though no payments are required, no interest is accruing. Unsubsidized loans, though, will still accrue interest. Forbearances are another type of payment postponement option. It's a little more broad than a deferment. General economic hardship can be a basis for forbearance. Importantly, though, interest still accrues on all of your loans during a forbearance period, and that interest that accrues can be subsequently capitalized, which means that interest then gets added back onto the principal, and then more interest accrues on that principal balance because it's a bigger balance. This can have pretty serious consequences. You can be in forbearance if you want for up to 36 months for federal student loans, but that can lead to thousands and thousands of dollars of additional money that you got to pay back. And so forbearances can be they can be a problem. And generally, I think folks should steer clear of interest accruing and interest capitalizing forbearances if they can. Private student loans often have forbearance options, but they're typically a lot more limited than what you would get for federal student loans, maybe just a year or less. Rather than being in a deferment or forbearance, generally speaking, we would much rather you be in repayment on your loan, so you're making progress. There's a lot of different payment plan options for federal student loans, and that can make figuring out your options a little bit overwhelming. To make it simple, I kind of group the repayment plan options for federal student loans into two very broad categories. There's what I call balance-based repayment, and then there's what we call income-driven repayment. We'll start with balance-based. For our purposes, it's just like any other type of debt repayment plan, like a car loan or a home mortgage. You have a fixed amount that you owe, you have an interest rate, and you have a certain amount of time to pay it back. And the particulars of that determine what your monthly payment is going to be. There are level or standard plans where you pay the same amount every month, every year until the debt is paid in full. That can be on a 10-year term, which is the automatic term that most borrowers are placed on, but you can extend it out to 25 or in some cases even 30 years for larger balances and consolidated loans. There's also graduated plans where your payments start off low and then gradually ramp up over time. Those plans tend to be a lot more expensive. It's rare that I've ever recommended a graduated plan, and it's particularly problematic, I find, for folks who've graduated law school who go on to work in big law. That's because your payments early on in the graduated repayment term are typically barely covering interest. And then a lot of folks don't stay in big law. They leave after a few years to go work for a nonprofit or in-house counsel or a smaller firm, and they actually take a pay cut. And so what winds up happening is you had these really high payments that weren't doing much for your balance when your income was high, and then your income goes down, but your payments go up under the graduated plan. It's a recipe for not good things. So I tend to steer clear of graduated plans. Now, if you can't afford payments under a normal standard plan, the next best thing is what we call income-driven repayment, or IDR for short. Again, this is only available for federal student loans. Being in an income-driven plan is generally better than being in a deferment and forbearance if you can't afford your normal standard plan payments. And here's why. Here's how IDR works. So there's multiple IDR plans. We're going to talk about that in a second. IDR is an umbrella term that we use to describe these collections of plans that all function a little bit differently, but on a foundational level, they're pretty similar. They use a formula. The formula is applied to your income. It's typically going to be your adjusted gross income, or AGI, on your federal tax return, adjusted for family size. And that formula is going to result in a monthly payment that is good for 12 months at a time. And then every year, you have to renew or recertify the plan by submitting updated income information, usually your last tax return. And that will result in an adjustment of your payment for the next 12 months. If your income goes up, your payment goes up, income goes down, payment may go down. And you make that adjustment or you recertify every year. And you can do that year after year after year. And many folks will pay off their loans in full, but if you don't, any remaining balance at the end of the repayment term, which is either 20 or 25 years, depending on what plan you're in and what plan you're eligible for, any remaining balance would be forgiven. So there's this safety net at the end in the form of loan forgiveness if your payments aren't high enough to cover if your income isn't high enough to cover your payments. IDR is great in many ways. It provides affordable payments for folks, even if you have a large and seemingly insurmountable federal loan balance. Generally speaking, it's a much better solution than deferment and forbearances. You're going to run out of those within a few years. You're not going to have made any progress towards anything while you're in a deferment and forbearance. Your balance is going to grow. You're at least making progress towards either loan payoff or loan forgiveness if you're in an income-driven plan. There are poverty exemptions. Generally, if you're earning within 150% of the poverty limit for your family size, you will pay nothing. And then it's just a percentage of your income above that limit. So folks with relatively low income may not even have to pay anything, and a $0 payment still counts towards your 20 or 25-year loan forgiveness term. And there's some interest subsidies that can come into play that can cut down on balance growth. Couple things to keep in mind, though. There are some downsides with income-driven repayment. One of which is that because your payments are based on your income and not necessarily on the balance, some borrowers are going to wind up paying less than the amount of interest that accrues each month on their loans. So in other words, if your interest is accruing at the rate of $400 a month and your payments are $200 a month, your balance might actually be growing by the difference of $200 a month, and you might actually see that balance grow over time, even while you make payments, and even while you make progress towards eventual loan forgiveness. That can make loan payoff down the road more expensive. If you wind up earning a lot more income, or you wind up being in a position to pay off your loans in full, it might be more expensive to pay it off years from now than it would be today. The other possible downside is that under current law, this type of loan forgiveness under income-driven plans could be treated as taxable income to you, as if you earned the amount of loan forgiveness in income in the year in which it happens, and then you might have to pay income taxes on that. And for folks who get a large balance forgiven, that could be a significant downside. Now, that being said, I think that there's a decent possibility we'll see some congressional reform that will exempt this from taxation. I can't promise that. Congress did include a provision in President Biden's recent stimulus package that exempts all federal student loan forgiveness from taxation through 2025. It's a temporary provision. It's not going to, have any effect on folks who still have, more than 5 years left on their term, which is most people. I'm hoping we'll see some sort of extension or some reform that will make that permanent. But you got to be aware that under current law, this type of loan forgiveness could be treated as taxable income. Now, in terms of the specific plans, there's 4 main income-driven plans. There's income contingent repayment, which we call ICR, income-based repayment, which we call IBR, pay-as-you-earn, or PAYE, and revised pay-as-you-earn, or repay for short. Each of these plans is unique and different. They all, again, function at a basic level in the same way, but they're all different. ICR is the oldest of the plans, and for most folks, it's just not going to make the most sense because it's the most expensive option. The exception to that are Parent Plus borrowers. These are parents who took out a special type of loan called a Parent Plus loan for their child. The child benefits by getting the educational benefit, but the parent is the borrower. The child student has no obligation on the debt. As a general rule, Parent Plus loans cannot be repaid under any income-driven plans. However, Parent Plus loans who consolidate their loans into a federal direct consolidation loan, which we'll talk about in a moment, they can repay their loans under specifically the ICR plan. They still can't repay it under IBR or the other 2 plans, but ICR could be an option for consolidated Parent Plus loans. I do want to be clear. If anyone who's listening to this as a Parent Plus borrower, doesn't necessarily mean you should consolidate. There are some significant possible downsides to consolidating. If you have a mix of Parent Plus loans and your own student loans that you took out for yourself, doing a consolidation of everything can be a major no-no because you'll limit the consolidation loan to ICR only. So, if you are a Parent Plus borrower, and you're considering ICR, it's definitely going to be worth it to look into that further before making a drastic decision about something like consolidation. But for folks who are not Parent Plus borrowers, ICR is almost never going to make sense. IBR, income-based repayment, is the most widely available income-driven plan. It's available both to direct borrowers and FFEL loan borrowers. And it has a pretty decent formula that can result in affordable payments. One thing to keep in mind about IBR and ICR is that for married borrowers, it will treat married borrowers as joint income earners if you're filing taxes jointly. They're going to look at your combined income with your spouse if you're filing taxes jointly. But borrowers can file taxes as married filing separately and base the payment off of their income alone. It's a way to exclude spousal income. That makes sense for some borrowers, but filing separately can have tax consequences. Some households will pay more in taxes if they file separately. So in those cases, you'll need to weigh any student loan savings under IBR by filing separately, weigh that against any additional tax liability or tax burdens inherent to filing separately and see how it shakes out. For some folks, it does make sense. For some folks, it does not. Pay-as-you-earn is along with revised pay-as-you-earn, are the most affordable income-driven plans, about 33% cheaper than IBR. So if you have a $300 payment under IBR, you would have a $200 payment under pay-as-you-earn. Pay-as-you-earn is limited to direct loans only. So again, that's why the loan type really comes into play here. And pay-as-you-earn also has really restrictive rules about the dates that the loans had to have been dispersed in order to qualify for pay-as-you-earn. Specifically, borrowers must have had no outstanding federal student loan debt as of October 1st, 2007. And they must have taken out a new federal student loan on or after October 1st, 2011. Obviously, none of us know the exact dates our loans were dispersed, so you can get that information by going to that FSA website, studentaid.gov. You can also contact your loan servicer. But bottom line is, if you qualify for pay-as-you-earn, in many cases, that's the best plan. It has the cheapest formula. It still has the marital flexibility of IBR and ICR, of allowing you to file taxes separately to exclude spousal income. It has the shortest repayment term. IBR and ICR are 25 years, whereas pay-as-you-earn is 20 years. So in many ways, pay-as-you-earn is the best plan, but you got to figure out if you qualify. It really comes down to disbursement dates and loan type. The fourth plan, revised pay-as-you-earn, has the same formula as pay-as-you-earn, and it does not have the disbursement date restrictions. It's still limited to direct loans only, which means that FFEL loans cannot be repaid under revised pay-as-you-earn, only direct loans. So in many ways, why wouldn't everyone just do revised pay-as-you-earn? Well, it's a little bit tougher for married borrowers. Revised pay-as-you-earn is always going to factor in the combined income of married borrowers, no matter how you file taxes. You could file separately and it's still going to factor in your combined income with your spouse. So there is sort of a large subset of borrowers here who are in a tough place. They don't qualify for pay-as-you-earn because of the dates they took out their loans, and they're married. And so it really comes down to IBR as married filing separately versus revised pay-as-you-earn as married filing jointly. Revised pay-as-you-earn is a cheaper plan, always factors in spousal income. IBR is a more expensive plan, but allows married borrowers to exclude spousal income if you file separately, but filing separately can have tax consequences. So it can be a little complicated for a number of borrowers, and it really comes down to which option best fits your situation. There are some decent calculators online. The Department of Education has its own income-driven repayment plan calculators at studentaid.gov, that same website. Student Loan Hero, which is a private company, also has some income-driven repayment plan calculators out there as well. So, and you can also run the numbers by your loan servicer by giving them a call. It really comes down to the numbers and how it shakes out for your own situation. So public service loan forgiveness is one of the more popular federal loan programs out there. It's related to income-driven repayment, but it's its own thing. Basically, it's talked about as a 10-year plan or 10-year program, but really the best way to think of it is 120 qualifying payments. What is a qualifying payment? Well, there's three main criteria of a qualifying payment. Number one, only direct federal loans count. So again, making payments on FFEL loans, Perkins loans, private loans, that's not eligible for public service loan forgiveness. Only direct federal loans will qualify for public service loan forgiveness. Number two, you must be on an income-driven repayment plan, like ICR, IBR, pay-as-you-earn, or revised pay-as-you-earn. Payments made under one of the other plans may not count. Now, there is another program called temporary expanded public service loan forgiveness that can sometimes allow for payments made under the wrong plan to count. It doesn't address the issue of making payments on the wrong type of loan, but you can sometimes get payments made under the wrong type of repayment plan to count. But technically speaking, for public service loan forgiveness, only payments made under an income-driven plan or the 10-year standard plan would qualify. So right type of loan, right type of repayment plan, and then number three, right type of employment, which is full-time for either a 501c3 nonprofit organization or a public or government entity like a government agency or a public school. You can also potentially work at multiple part-time positions if your combined hours are at least 30 hours a week. So right type of loan, right type of payment, right type of employment. You make an on-time payment under one of those, while meeting those criteria. That's a qualifying month of payment. You do that 120 times. That gets you to public service loan forgiveness. It's referred to as a 10-year program because if the 120 payments are made consecutively, that's 10 years. But the payments don't necessarily have to be consecutive. It just means it would take longer than 10 years if they're not consecutive. The program was enacted October 1st, 2007, and it's not retroactive to before that date. So no payments made prior to October 1st, 2007 can qualify. Importantly, public service loan forgiveness is a tax-free form of loan forgiveness under federal law, meaning that unlike the loan forgiveness under income-driven repayment, which could be treated as taxable income, public service loan forgiveness is a tax-free event. So you can get your loan forgiveness much sooner than the 20 to 25-year term that you would get under income-driven repayment, and it's tax-free. So in many ways, it's a really crucial program for a lot of people. There is a form that borrowers can submit called the employment certification. The Department of Ed recommends that you resubmit it about once a year. That can allow you to confirm that your employment qualifies and get periodic updates on the number of qualifying payments you have made to date. Another type of loan forgiveness program for teachers, we call it teacher loan forgiveness. This is a much more specific program than public service loan forgiveness. Often these two programs are conflated, but these are actually separate programs. For this program, you have to have the right type of loans, which are federal Stafford loans dispersed after 1998. You have to be a specific type of teacher, usually math, science, or special ed, working in a specific type of school, which is a Title I low-income school that's listed in a special Department of Education database. And you have to work for 5 consecutive years. Forgiveness here is capped at $5,000 or $17,500, depending on whether you're teaching at the elementary or middle or high school level, and also what type of teacher you are, whether you're math, science, or special ed, or not a math, science, or special ed teacher. That determines your award level. It's a useful program for some teachers. The issue is that you cannot make simultaneous progress towards both teacher loan forgiveness and public service loan forgiveness, which means that if you want your 5 years to count towards the teacher loan forgiveness, they're not going to count towards the public service loan forgiveness program, and vice versa. If you want your 5 years of payments counted towards public service loan forgiveness, you're not going to be able to get your teacher loan forgiveness award. So whether or not you want to go for one or the other really depends on your unique circumstances, where you're teaching, how much student debt you have, because public service loan forgiveness has no cap. So even though it takes twice as long, for some folks, that program makes more sense than teacher loan forgiveness, which has a relatively low cap on that. Perkins loan forgiveness. So I mentioned Perkins loans are neither direct nor FFEL loans. They have their own unique benefits. We're going to talk about consolidation in a second, but because Perkins loans have their own unique benefits, you might want to be careful about including a Perkins loan in a consolidation. That would cease to be a Perkins loan if you consolidated it. But there is full forgiveness available for Perkins loans under very specific full-time occupations. So this is a non-exclusive list. These are just some examples: nurses, medical techs, providers of services for the disabled, speech pathologists, special ed teachers, also public defenders, I believe librarians, police officers. There's a whole list of occupations. You can get this at studentaid.gov, where you can get up to 100% of your Perkins loan forgiven without having made any payments. There's a form you complete once a year, which essentially gives you an interest-free deferment. You complete that year, a chunk of your loans get forgiven, and then at the end, you'll have full forgiveness after 5 years. So it's really a really useful program for folks who are working in specific professions that are covered by Perkins loan forgiveness. So let's talk a little bit about federal direct consolidation. There is a program through the Department of Ed called the Direct Consolidation Program that allows borrowers to combine existing federal loans into a single direct loan. This can have some benefits. It's interest neutral. It's basically the interest rate would be the weighted average of the loans that you're including in the consolidation. It can simplify your repayment. Instead of having multiple loans in multiple places, you can have a single loan with a single balance and a single bill. Importantly, it can convert non-direct federal loans into a direct loan. Private loans cannot be consolidated through the federal direct program, but existing federal loans like FFEL loans and Perkins loans can be consolidated into a direct consolidation loan. So for instance, if you have FFEL loans and you want to qualify for public service loan forgiveness, which is limited to direct loans only, you might want to consider consolidation. That'll convert your FFEL loans into a direct loan, which will then make it eligible for a program like public service loan forgiveness. It can also open up new repayment plan options. A plan like revised pay as you earn, for instance, is limited to direct loans only. If you have FFEL loans are only accessible to IDR. So if you want that cheaper plan, doing a consolidation can sometimes make sense. I also mentioned Parent Plus borrowers might need to consolidate if they want to access the ICR plan. There are some pretty significant drawbacks in some cases though. Number one, it's a new loan and it restarts your repayment term. That can be dangerous. So for instance, if you have existing direct loans and you've made 4 or 5 years of progress towards public service loan forgiveness and you consolidate those existing direct loans, you've just erased those years of progress that you've made. Same is true if you have made 10 years of progress towards your IDR forgiveness on your FFEL loans and you consolidate those loans into a direct loan, you've erased those 10 years that you've accrued towards that repayment term. In some cases, it still makes sense for folks to do it, but you want to be really careful and make sure that you're making the right decision. Any outstanding interest typically would be capitalized, meaning added to the loan balance, and individual loans would cease to exist, which would deprive you of the option of paying off loans one by one. And also, like we just talked about, if you consolidate a Perkins loan, it ceases to be a Perkins loan and it loses those benefits. Now, I make a distinction between consolidation and what I call refinancing, which is basically utilizing a private lender to pay off existing loans, and you end up with a new loan to a private lender. That can function as a consolidation if you're refinancing multiple loans into a single new private loan. But to avoid confusion, I typically refer to consolidation as the federal direct consolidation program. I refer to anything you're doing with a private lender as a refinancing. The main reason folks want to refinance their student loans is to get a lower interest rate and better repayment terms. If you get 7% rate and you're on a standard plan and you want to bring that down to 4%, government isn't going to change your interest rate. That's set by Congress. The only way to change your interest rate is to find a better lender that has a better rate, and that can lower your payments. But there are some significant downsides and considerations if you're going to do this. Big one is if you refinance your federal loans through a private lender, you are going to forever lose out on all federal student loan program benefits and consumer protections. That means if you have a federal loan that is eligible for income-driven repayment or public service loan forgiveness and you refinance it through a private loan, you're walking away from those programs. You cannot reconvert a private loan back into a federal loan again. It's a one-way street out of the federal system. You also are going to lose out on programs that you might never need, but are good to have around, like a disability discharge if you can't work anymore because of an injury or an illness, default resolution if something terrible happens and you fall behind on your payments, and generous deferment and forbearance options as well. If you're looking at refinancing, definitely pay attention to the interest rate, the specific repayment terms and conditions, read the contract. You want to try to steer clear of any fees that are going to get added to your loan. That will dilute any benefit of a lower rate. My general rules of thumb here, if you're going to refinance existing high interest private loans through a new private loan, that sounds great, right? As long as the terms are better, it already was a private loan, so it's staying a private loan. If you can get better repayment terms out of it, go for it. If you're refinancing high interest federal loans, that's a much more murky decision. You got to weigh what you're gaining versus what you're giving up. There are ways of mitigating some of what you're losing, like having additional life insurance and disability insurance, but you want to be careful and make sure that it really is the right decision for you, because it's a choice that you can't undo once you go through the refinancing process. So some brief words on COVID-related relief right now. So last year in March, Congress passed the CARES Act in response to the COVID-19 pandemic. That legislation suspended all payments, all interest, and all collections activity on all government-held federal student loans. Now, there's a lot of confusion out there about why some federal loans were covered by this and some are not. Well, all direct loans are held by the government, so all direct loans are covered by this suspension, but a lot of FFEL loans are not. Some FFEL loans at some point were acquired by the government and so might be covered, but the majority of FFEL loans are still held or owned by private lenders, and so they are not covered by the CARES Act, and that's just how Congress wrote the law. Perkins loans are not covered, and of course, private student loans are not covered as well. The way this works is interest is zero, no payments are due or required. If you're in default, no collections activities are currently happening. It's been extended several times by President Trump and then subsequently by President Biden. Importantly, the months of suspension are going to count towards loan forgiveness terms as if payments were being made, even if you don't make any payments. This makes this type of payment suspension completely different from a traditional deferment or forbearance, which generally doesn't count towards anything. The COVID forbearance does. So in other words, even though you know payments are required and you're not making any payments, just having the suspension in place counts towards your 20 or 25-year term for income-driven repayment loan forgiveness, and it counts towards your 120 payments for public service loan forgiveness. You can nevertheless opt out if you want to make payments anyway. If you have been making payments, you are entitled to a refund of those payments. You can contact your servicer for more information, and you also want to ask your servicer about the implications of that, but you can request a refund if you've been making payments and while being in a suspended status. The most recent extension by President Biden ends on September 30th. So you should expect that your next payment will be due in October. It's possible that that could be extended further. The administration has said that they're going to make that decision based on the status of the economy and the pandemic at that time. They're not ruling out a further extension, but it's looking like there probably will not be a further extension. That's my guess. I would say definitely plan on resuming repayment in October. So the $1.7 trillion question, is there going to be some sort of broad student loan forgiveness out there? Short answer is we don't know. I can tell you with confidence, I don't think everyone's going to get their student debt wiped out completely. I just don't see that happening. There's a debate right now going on in Washington about whether there should be student loan forgiveness, and if so, what does it look like? Who's going to benefit? Are there going to be limits? Advocates and some folks in Congress are pushing for $50,000 or more in broad student loan forgiveness. President Biden has expressed his comfort with that, has been more comfortable with something around 10,000 student loan forgiveness. There's a question about whether Congress will pass legislation or whether Biden can and will do something via executive order. Certainly, if it's done by executive order, it's not going to cover any private student loans. And Biden has been, I would say, reluctant to use executive action to enact widespread student loan forgiveness. And he's not sure he has the legal authority to do so, although a lot of folks think he does. Where things stand right now is Biden has ordered a legal review by the US Department of Education and the Department of Justice to ascertain whether he has any authority to cancel student debt through executive action. That legal review is ongoing. We don't know when it's going to conclude. My guess is it will conclude before September. And I would imagine that's probably the goal. And we just can't speculate what, if anything, is going to happen here. My gut on this is that if there is some sort of broad student loan forgiveness, it will be capped, maybe 10,000, who knows. And there might be further restrictions as well, including the type of loans that qualify, this program you attended, or your income level. It's just too soon to say, however, what this is ultimately going to look like. But that's where things stand right now in terms of broad student loan forgiveness. All we can do is just wait. Some important resources, studentaid.gov I've brought up a few times. That's where you can get information on your own student loans, explore some of the programs we talked about, including income-driven repayment, public service loan forgiveness, and get some free information on a lot of these programs and run some calculators. National Consumer Law Center has a website within their website called the Student Loan Borrower Assistance Project that also has a lot of great free information on a lot of these programs. And IDRinfo.org is run by the Institute for College Access and Success. Lots of good free information on income-driven repayment programs, as well as public service loan forgiveness. So with that, I will take some questions. Oh, I think, Matt, you're on mute.
That I am. Thank you. Welcome to the world of Zoom. I should have figured out by now. So we do have some questions in the chat. I think some of them you've kind of covered, but I just kind of wanted to go over them just in case. But first, just kind of, you talked a little bit about student loan forgiveness. The options again, if you wanted to do a quick, which ones there were. I think that was kind of what were the options for student forgiveness.
I mean, there's too many options to go over in a single presentation. The ones that I talked about was loan forgiveness tied to income-driven repayment plans, public service loan forgiveness, teacher loan forgiveness, and loan forgiveness for Perkins loans. Those are the main loan forgiveness programs that most people are going to be interested in. There are some other programs that probably don't apply to most folks here. There's, for instance, a disability discharge program. If you're unable to work anymore, or you can't maintain gainful employment because of illness or injury, there's a disability discharge program. There's some school-based, discharge programs that I'm not really going to get into here. Studentaid.gov, however, will have all the information and all the available loan forgiveness programs that are out there.
Mm-hmm. Great, thank you. So some of the other questions, and feel free to kind of, I think one of the things that we told at the beginning is sometimes we can't really ask specific questions for individuals, but we might be able to kind of do more general for some of these questions. You also kind of talked a little bit about in getting solicitations from SoFi and Citizens Bank to consolidate a larger loan to a 2.24 loan, so a little bit lower, but is afraid to refinance and may lose all the benefits for future payment plan chances, deferment, forbearance. I think you did cover this, but just wanted to double check. That is the case, right?
Yeah, I mean, it doesn't mean that, folks definitely, if you have federal loans and you are looking to refinance through a private lender, I'm not saying it's definitely a bad idea all the time. You just need to be aware of what you're giving up, So like I said, if you're refinancing an existing high interest private loan with a new lower interest private loan, in many cases, that's probably fine, depending on the specific terms and conditions. It's a lot more complicated, though, if you're refinancing federal loans through via a low interest private loan. The question is, what are you giving up? You're giving up, all these federal programs that we talked about: generous deferment and forbearance, income-driven repayment, loan forgiveness programs, a death and disability discharge. Depending on the contract, the private lender might offer some of those things, but it's probably not going to be as robust of protections as you would get with federal loans. There are ways of mitigating some of those risks through insurance and savings and other strategies. But I'm not saying definitely don't do it, but I'm saying be aware of what you're giving up, what the risks are, and that is gonna, you'll just have to weigh it and make a call.
Great, thank you. So the next one that we have here is, has the PSLF forgiveness become easier now that we're some years in with the first cohort of borrowers seeking forgiveness? Basically just saying, I remember hearing stories from 2017 and 18 where there was a lot of complications and rather low success for forgiveness rates for those who reach their 120 payments.
Yeah, it's a good question. So the public service loan forgiveness program has been riddled with problems. It's a complicated program. Again, you got to have the right type of loan, right type of payment, right type of employment. You're missing any one of those criteria, the payment doesn't count. Those criteria were not really well communicated to folks for many years, up until very recently. And there's also just administrative mistakes happening by servicers missing payments or not counting everything. The program still has a low success rate, unfortunately. That being said, it is improving. And as communication gets better and as folks understand the program better, we are seeing, I think, more success out of it. It's still, in my personal opinion, we need reform to make this program really work for people. But for what it's worth, at this point, I've had several clients who have successfully gotten their loans forgiven under the program, so I can say firsthand that it does work. And I've seen folks with their balance, go down to zero, and the relief and excitement that leads to. So it is a legit program and it does work. It still is problematic. But in my view, the best thing you can do is understand the requirements, make sure you're meeting the requirements, and then complete that certification form regularly to ensure that you're getting those payments counted. And if there's a problem, you have time to address it before you reach the end.
Great. The next question that we have is, if we have the means to pay off loans in full, is there any valid reason not to do so?
It's a great question. There's no, broad answer to that. And generally speaking, if you're paying off your loans in full over time, it's going to be cheaper to pay it off in a lump sum now than it's going to be to pay it off in installments with interest over a 10 or 25-year repayment term. So from that perspective, it could be cheaper. That being said, for folks who are on track for public service loan forgiveness, for instance, where you stand to get a large amount of tax-free loan forgiveness if you're committed to a public service career, may not be much of an incentive to pay it off in full if you're going to wind up paying a fraction of that and getting the rest forgiven tax-free. For other folks, it's more complicated. It might come down to your other competing financial goals. You have the means to pay your loans off in full, but you also want to make sure that you're saving for retirement. You want to buy a house, do you have enough for a down payment? You want to save for a kid's education. So for some folks, it's just, where does that money fit into your larger financial picture? And that's a more personalized question and answer.
Great. The next one we have, and I'm hoping that with your expertise, you'll be able to understand the question more than I can right now, but can it be possible to enter into a payment plan, but was not eligible, or specifically the entering a pay plan, but not fall under the date criteria?
I'm not sure exactly. I might understand the question. I think it sounds like what the question is asking is, can you enter to a payment plan that you're not eligible for? And the answer is generally no. I mean, I've seen servicers make a mistake where they accidentally let someone into a plan that they're not supposed to be in. And it does happen, but at some point the servicer is going to find out and kick you out of that plan. So for instance, I said a Parent Plus borrower cannot repay their loans under an income-driven plan other than ICR. That means that, if they accidentally let you into IDR, it's probably a mistake, and they're going to undo that at some point. You don't want to bank on that. If you don't meet the date criteria for when your loans were dispersed for the pay-as-you-earn plan, for instance, so I said for pay-as-you-earn, only direct loans are eligible, and you had to have had no outstanding federal student loan balance as of October 1st, 2007, and you must have had a new federal loan disbursement on or after October 1st, 2011. If you took out your first loan in 2006, and you still had a balance in 2007, then you're not going to qualify for pay-as-you-earn. So you probably are going to be rejected from that plan if you apply to it. If they somehow let you in, it's a mistake that's probably going to be undone.
Great. And the next one that we have is for the Perkins loans. It sounded like you said there was only a form the person would need to fill out. How much is the forgiveness amount for that?
So it's up to the full amount of the Perkins loan. The way it typically works is it requires, I think, 5 years of service for most of the occupations. And the way it would typically work is you fill out a form once a year, typically your school or the Perkins loan servicer that the school is using. And that results in interest-free deferment for the year, and a portion of your loan gets forgiven for each of those 5 years up until the last year when you'll get the remaining chunk forgiven. But it can provide for complete forgiveness of the full Perkins loan, depending on the Perkins loan amount. To get more information, studentaid.gov, or contact your school or the Perkins loan servicer that the school has contracted.
Great. So the next one we have is, what would be the purpose of requesting a refund for the payments you made during this time? So with the COVID relief, is there a significant benefit of trying to get a refund back?
Well, I mean, it's a good question. So, interest is frozen. So for folks who have been on, say, a standard or extended plan and their goal is to pay off their loans in full, there's every reason to continue to make payments because your payments are going entirely to the loan balance. It's not going to ongoing accruing interest, and having a 0% interest rate is hard to beat. For other people, for instance, folks who have who are on track for public service loan forgiveness and stand to get a good amount of loans forgiven at the end, tax-free, there's certainly a school of thought that says, well, why pay anything more than you need to? If the payments are going to count towards the 120 payment term anyway, as long as you're continuing to work in qualifying employment and no payments were required, certainly those folks might want to get a refund. There's other people who, maybe you were making payments because you could, and now you have a hardship and you need money and you want to get that money back. You can do that. So it's a personal decision. Definitely talk to your servicer, make sure that it's the right decision for you. I think probably the folks that would most likely want to get a refund are those who are making payments despite being in a suspended status while on track for public service loan forgiveness, and might, didn't have to make payments. Probably those folks would be most likely to want a refund, but it's a personal decision for people. So make sure you contact your servicer and make sure that there's no downsides for you.
Great. I think the other one is just more of kind of a general question that I've kind of got from a few different people. And I think it really goes to some of the forgiveness loans, and basically to the websites that you put for availability for people to kind of check on different things. Does that list out all of the different kind of nonprofits and other things that would qualify for someone to be able to get a forgiveness?
The website studentaid.gov has a lot of information on the programs and a lot of information on the program requirements. It's going to go in a lot more detail than what I was able to cram into this session. There is, I believe, through a servicer called Fed Loan Servicing, or it might be on studentaid.gov. I'm not entirely sure offhand, but there is something called the Public Service Loan Forgiveness Help Tool, where I believe the Department of Ed is trying to compile a database of employers that qualify. It's a new database. I would imagine it's not complete and not perfect. Excuse me. But that is up if folks want to check that out.
Okay, great. I am just trying to go through the chat to see where we have questions wise. One of the questions that we had is if someone was scammed by a federal loan relief, what can they do legally?
It's a good question. Yeah. So, I mean, there's a lot of scammers out there, unfortunately. There's a lot of companies out there that are promising loan forgiveness that doesn't exist, or they're promising to, make your loans disappear or give you low or zero payments. Generally speaking, if you're being solicited by a company that is not your student loan servicer, it's definitely a reason to be suspicious. So be careful. There's a lot of scams out there. If you were scammed, I mean, I've dealt with some of this on behalf of some clients. It's tough. A lot of these companies are fly-by-night companies that sort of, pop up and then disappear. You can reach out to, for legal advice to, not to me, but to an attorney if you want. You can also contact the Mass Attorney General's office. They might be able to help. They have a student loan division that can provide free assistance. And the Attorney General generally has been, interested in trying to stop some of these scammers. So that might be a good place to start.
All right, great. Well, we are at time. So I wanted to give you any parting thoughts that you may have for everyone just before we wrap up.
I mean, for folks who are subject to the payment pause, now is a good time just to kind of check up on everything, be prepared for resuming payment in October. Obviously, keep an eye on the news to see if any new developments happen. But I think that's sort of the big thing looming over most folks right now is when are my loans going to start repayment? Plan in October. It could change, but I think that's what folks should be aware of.
All right, well, great. Thank you so much, Adam. This was a really great presentation. And then for everyone that is still on, I just wanted to let you know that we will, this was recorded and we will have it up on our YouTube channel. And hopefully you'll be receiving a survey from us shortly. So please make sure to fill that out for us. It's really helpful for us to be able to kind of get these programs for our alumni and different topics that we have. So thank you very much, everyone. Really appreciate it. And I look forward to seeing you at future events.
All right. Thank you. All right. Bye-bye.